Right, hello everybody. Welcome to today's podcast. It's the 27th of April 2020. What are we, week 5 or 6 of lockdown? It's kind of hard to remember these days, really, isn't it? All weeks and days seem like the same, don't they? But anyway, we're getting there. We're getting through it a little bit. There's certainly some optimism over the lifting of the lockdown in some of the countries across Europe and even in the US as well. So we're going to be talking about that and the effect that that's then having on the markets in today's Trend Signal Trading podcast. As ever, I'm joined with our resident expert and chief analyst, Jerry Miller. Hi, Jerry.
Yep, hi there.
How are you, Jerry? You all okay?
Yeah, not bad actually. The sun, I did think we were saying goodbye to the sun for a week and a half, but it's come out again. That must be a good sign, an omen.
I think we're headed for lots of rain, so I think we might have had our summer. What's the opposite of an Indian summer? I don't know. A West Indian
A,
summer.
a, a, an English summer?
Yeah, probably, actually. But
That's
things looking a little bit brighter, at least with the markets and certainly lifting some of those lockdown restrictions, Jerry.
Yeah, it's interesting. There are a number of European countries that are ahead of us. Certainly, the likes of Italy, Spain, Germany, and Switzerland have all announced measures to ease the lockdown, at least in certain areas. And I think there's a bit of pressure. Old Bojo returning to work this week from following his recovery from COVID-19. He's under a bit of pressure, although you've probably seen, or most of us have seen, his first press briefing outside number 10 this morning. And the message is, let's not spoil it. We've done the heavy lifting. Let's not ruin it towards the end of this lockdown. So I think there might be a few restrictions eased, but it looks like we're going to have to keep this for another couple of weeks, as originally planned. So
That's the
yeah,
danger, isn't it? As soon as you start talking more positively about things, all of a sudden everyone will be back out on their back out in their cars, won't they? If it needs to be a sort of
yeah,
a balanced way of demonstrating it. I was listening to something the other day, an expert, I can't remember his name now, but he's saying about how the sort of likely first step is probably to sort of open up schools, because once they open up the schools, that then allows more people to work more effectively from home because they're not having
yeah,
to homeschool and work, which from my own perspective is quite challenging. My patience has been tested, that's for sure. And then, of course, maybe universities can then get started again. It's going to be a drip, drip, drip thing. I think Bill Gates was was being interviewed saying
yeah,
it's just got to be done slowly, testing, 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 just to make sure it works, really.
yeah. I think the best thing to do is to listen to the government. The trouble with the media is that the media are made up of people who are really just giving their view and selecting evidence to sort of back up that view. And and a lot of people that I talk to, I have a number of these Zoom meetings at weekends, social Zoom meetings, as it were, and we all find the sort of blizzard of media reporting and views, and the lockdown's good, the lockdown's bad, it's bad to have hairdressers opening up, it's good to the pubs can open, no they can't, the gardens can, and all I know is that there is no effective therapy, there's no available vaccine. Older people with existing medical conditions are at a greater risk, and if you had it, you may only have temporary immunity to further infection. It doesn't make up. It just sounds like this is going to be with us for longer than a lot of people are trying to make out or be positive about, if you know what I mean.
The problem you're always going to have with the media, it's just about the headline, isn't it? And everything is based on advertising and so on, and newspaper sales and whatever. So it's whatever gets the biggest headline that gets the most clicks, that gets the most impressions, that gets the most banner advertising and so on. So
Mm.
you always end up with these. No one's gonna. They're not going to write an article saying, "Hey, let's do exactly the same as last week," because nobody's going to click on that article. That's
Yeah.
it's
Well,
always
that's
going to
right.
be
And this, we haven't had a pandemic for 100 years. That's sort of what we're dealing with here. Not a pandemic like this. We had Hong Kong flu back in the late 60s, but you've got to go back to the sort of Spanish flu back in this 100 years ago,
yeah.
just over. And for that reason, no one really knows what's going to happen. There's a lot more understanding of pandemics, and people study the effects of it and how they spread. But all I know is the only way out of this is an effective vaccine. That's what I believe. And in the meantime, the only way to get through it, through relaxing the lockdown is to let out the least vulnerable first and see what happens.
Yeah.
Let's face it, these measures are to protect the older population who are the most vulnerable. And ironically, it's the older population who have the least to lose financially. It's the young people who have been furloughed, who have been made redundant, who need the the opportunity and the to be allowed to go back to work, to start earning money again.
Yeah. Well, that's
Anyway,
why lifting some of those restrictions has been ultimately, fairly positive for the equity markets, hasn't it? So there's been there's been again a bit of strength in the equity markets again today, hasn't there, Jerry? I mean, down a bit
yeah,
last week overall, but
well, we had a bit of risk aversion, risk off last week. When we talk about risk off, we're talking equities going down, bonds going up, and the dollar picking up a little bit. But it's sort of changed towards the end of last week and this overnight, certainly from the Far East, which is sort of spread to our markets and the US indices as well. But I still think the markets remain pretty wary, Adrian. The whole move last week was on the back of concern about the first quarter earnings in the States, because central bankers have made it clear they don't know what's going to happen. Jay Powell, the chairman of the Federal Reserve, said that he couldn't predict what's going to happen in the future because of the novel nature of the pandemic. So forecasts were pretty much impossible. So we're left now with, well, who do we look to? What do we look to? I know what. Let's see how the companies are actually doing. And it's
yeah,
this week that's really important, where we've got a lot of big hitters coming out. I mean, a lot of big hitters, not just in the US, in the UK, Europe. And it's those earnings where companies are going to say, we can't afford to pay a dividend. We might pay a dividend in
yeah.
Q2, Q3. And it's that sort of feedback that will, I think, determine how the markets fare at the end of this week, by the end of this week, I should say.
Yeah, I mean, we've got companies like HSBC, Google, BP tomorrow, Facebook Wednesday, Barclays Wednesday, Royal Dutch Shell, Apple Thursday. Yeah, there's some absolute monsters, aren't there? But of
Yeah,
course,
this
it's the
big.
small companies as well that are sort of up against it too. So, I know you sent me an interesting article about small and medium enterprises. Half of them will run out of cash in the next 12 weeks. I mean, a lot of people find
Yeah.
that sort of quite surprising, but I think we said in previous podcasts that businesses are in a similar sort of way to people. We talk about people being only 1 or 2 months pay slips away from not being able to afford their mortgage. I think a lot of companies are in a similar sort of position with their costs.
Yeah, I mean, young people can save and do save, but they don't have anything like the savings of the older section of the population. And you've got to remember, SMEs, most of them employ sort of 5 or 6 people at most. And why would you keep an excessive amount of cash in your business for an event like this? Well, you might turn around and say, well, because if you had done, that's what the outcome would have been. But this is a once in 100 years sort of event. So, and it
the
is a
problem is
serious.
you can't, can you? You have to reinvest that money because otherwise you wouldn't be competitive against all the other the competition that are investing that money. So you're sitting there on cash, but they're all investing it and helping to grow their businesses faster. So you probably end up going out of business because you're
Well,
not able to advertise as fast and so on as aggressively as your competitors.
if your strategy was to build up some sort of buffer in your balance sheet for an event like this, as you said, you'll get a lot better return investing it in your own business than you were asking HSBC or Royal Bank of Scotland to pay you a return of 0.25% per annum. Yeah. Well, the important thing with cash, of course, is cash, and it's still there, as opposed to some businesses who just are not going to survive. They just won't.
Well,
it's
we'll get some more guidance on that, won't we? Sorry, Jerry, to interrupt you. You can.
No, and it's interesting. I was reading the press yesterday, Sunday press, and the church were sort of coming out and saying that should businesses that are domiciled in tax havens be given support from the UK government, as important as they might be. And it's an interesting dilemma, isn't it? Should Richard Branson's Virgin Atlantic be given, Virgin Airlines be given support when he lives in luxury on his own island? It's those sort of moral hazards that you've got that need to be thought carefully about. And I think Rishi Sunak has said only at the last resort, when all avenues have been exhausted, will the government consider helping some industries that have got very rich backers. And I think he's got a point.
Yeah. It's really interesting. I remember when they came out with, the UK government came out with the scheme for furloughing, and then all of a sudden everyone came out, well, what about the self-employed? Of course, self-employed don't pay the same sort of national insurance levels and so on and they can offset costs that employed people can. I know they don't have the same protections, but it's a similar sort of argument, isn't it, in a way? And so is people who pay themselves through dividends from their business rather than pay. Should there be protections for them? But they're not paying national insurance, really, though, are they? Or maybe so much that it's a very controversial subject to get into, isn't it? And I'm probably annoyed quite a few listeners by making those statements.
Hey,
The point I'm trying to make is that there's difficult conversations to be had everywhere about this, isn't there? And
look at the supermarkets in the UK. They're all benefiting from the business rates holiday that the government have provided businesses. So it's not just they can't single out businesses, but the food retailers. I think Tesco is saving like something 400, 500 million, something like that. And coincidentally, they're talking about paying out a dividend of that amount. What does that look like?
Yeah. And interestingly, and they've changed their behavior. They're obviously doing quite nicely, but they're as a business, and of course they're not having the offers like they used to. So it's killing time for them, because they don't need to put the offers in. People aren't going to restaurants, so they're eating at home instead, and they're buying it all from Tesco and such.
Well, here's a statistic, and I think this is one of the reasons why there are more available slots on is it Ocado, the one that the independent food delivery service. They put up prices by 16%, and there are no offers whatsoever.
Yeah, there you go.
But I mean, you might
market
say, well,
forces, huh?
Well, that is it. It is, and maybe their costs have gone up as well, and maybe they've invested a lot more money in making more deliveries available, but it just doesn't read well. Not for a lot of people, anyway.
No. Okay, so what about the movements last week then? So overall down a little bit last week, Jerry, on the indices, that is anyway.
I don't know whether you can hear me. I'm sort of losing a connection a little bit.
Yeah, no, I'm with you now.
Just 1 second.
I can hear you now. I'll talk a little bit though, but
Okay,
I can hear you fine.
We're back again. We're back again. So
Okay.
last week, markets, as I said, had a bit of a risk-off move. FTSE modestly down 35 points. The DAX was down 290. That was quite a bit more, in fact, about 2.75%. But US markets also stumbled a bit. The Dow giving up 460 odd points, and the S&P 38. So between 1.4, 1.9% lower, and also the Nikkei shedding 635 points, about 3.25%. And I think this is all to do with the US earnings in Q1 and how bad it might be. And as I said, we've got a few more of those this week that we've mentioned a couple of times already. So Q1 earnings and some big hitters coming out, as we mentioned. So it'll be interesting to see how the UK banks are doing, how the oil companies are, and there's just this big sort of worry about dividends and who's going to be forced. Well, not forced to. I mean, the UK government has forced banks, or the FCA has forced banks not to pay any dividends for the foreseeable future. But the oil companies, can they afford to pay much in the way of dividends compared to what the market is expecting? And it's all of that has been affecting those markets. Other sectors, currencies, well, along with stocks, the dollar benefited marginally last week, Adrian, not a lot. Sterling slipped a little bit, the euro slipped a little bit, but the yen was unchanged. I'd say a marginal
Gary, just quickly,
move.
You mentioned obviously risk off. For our listeners who perhaps don't listen to, or maybe this is their first time on one of our podcasts, what does risk off and risk on actually mean? And how does that affect sort of different baskets of currencies and indices?
Okay, yeah, that's a good point, actually. So what the jargon risk off is reducing your risk to the markets.
So
And the
taking
risk,
risk off your portfolio,
correct.
basically.
So curtailing or reducing your risk means moving out of shares, which are traditionally riskier investment, moving into cash, moving into sovereign bonds. So that's where you buy a bond issued by a government that pays you a guaranteed return. It's a lot lower than the stock market, but you always get your money back. And a move into the dollar is often regarded as a safe haven move if you're in cash, because the dollar buys a lot more things than good old sterling and the euro and the yen and the Swiss franc. But they vary in sort of attractiveness in terms of being a safe haven, a haven for safety when things are looking a little bit risky. So risk off last week, move out of equities into bonds, into the dollar, into gold, and risk on is the other way around, where investors move into equities which are regarded as riskier assets, so engaging in more risk in terms of their portfolio.
And just for in terms of currencies, how does that translate to currencies like the Aussie dollar, New Zealand dollar, Canadian dollar,
Okay.
with risk on?
Yeah, that's interesting. So risk on, where the market's recovering, traditionally favors the likes of the Aussie dollar, the Canadian dollar, and the New Zealand dollar, which are regarded sort of as commodity currencies. So when the markets are doing well, base metals will be doing well. Oil, God, that's a bit of a moot point. But generally, they will do better. But in risk-off scenarios, the commodity currencies that I've just mentioned wouldn't perform so well. In risk-off environments as well, you tend to find Far East investors love buying the yen. The Japanese central bank and the Japanese government hate investors flooding into the yen because it causes them all sorts of problems in terms of making their goods, exportable goods, uncompetitive.
Yeah,
But
an
that's
economy like Japan, they want cheap exports, don't they? Or cheaper exports. So a low valued yen is better.
So you often see accompanying a rally in the yen, a fall in the Nikkei, because the Nikkei is made up of some very big exporters that do not like a strong yen. When I talk about a strong yen, the yen is getting stronger today, for example. So the number of yen last week was sort of 107.80, 108. It's now 107.15 to the dollar. So the number of yen is smaller, i.e. the yen is rallying against the dollar.
Yeah. So we've actually had a continuation short on the 24th, so Friday's close, and we've still got one open from the 13th as well. So we're on the right side of that move. And I suppose for traders, what you're trading and that risk on, risk off is more of a view at the moment about how you feel about this COVID-19 and the impact. So if you feel that, that there's risk, we'll have another big sort of, burst of negativity, then that would, I guess, lead to a reduction, a fall in stocks. But you'd expect also a fall in things like the Australian dollar and Canadian dollar, and probably more strength in the US dollar, wouldn't you? And probably gold.
Yeah.
There's a correlation in these markets is really what I'm trying to say. And the way in which you trade it is really based on, I guess, that perception of how COVID-19 will play out.
Yeah.
I think a lot of people don't understand that correlation, which is why I wanted to bring it up. Really.
No, that's a very good point. Very good point.
Okay.
One other thing.
What about oil, Jerry?
Yeah,
what on
oil. Well, we mentioned this time last week, didn't we, in our podcast, that the storage capacity in the US was drying up, as it were, or filling up, more to be accurate. And that's exactly the problems that existed last week. If you can, you've got that. You were showing US oil there, so that's exactly the market we have to look at now. This particular chart from Charting Center does not show a negative price because a lot of charting applications can't have a negative price. But last week, that's exactly what happened. Exposed the whole market to the reality that is the oil market with massive overproduction now compared to demand. Demand has collapsed by a third. Sure, you've got OPEC Plus cutting production, but that's nothing compared to what's happening with demand. And so oil, they haven't been able to cut down the production just like that. There's a lot of oil in the pipeline, metaphorically and physically speaking, and it's that oil that's had to find a storage, a home for it, and traders rush to find the storage with all that excess inventory, and this is what happens with the price. You had producers, traders who own the oil having to pay to have the oil taken off their hands, which effectively means a negative price. Some traders paid up to $37 a barrel to have their oil stored, which is a nightmare. So effectively, it means that
they were paying people to take it off their hands.
Correct.
So normally they're receiving money, obviously. I know it sounds ridiculous to explain it, but it's just what a ridiculous situation it is. So normally, obviously, you'd sell your barrels, but here you're paying people to take it off your hands. So I put something up on Facebook, and my friends were like, hang on a second. So you telling me that I could receive money and receive the oil if I can store it? Well,
but of course, the problem for people who own oil is no one wants it, no one needs it at the moment,
Absolutely.
and there's no place to store it. And if you want to store it, guess what? You had to pay $37 to someone to take it off your hands, which means if you and I, Adrian, owned a big storage tank somewhere, wherever it might be in the US, say it could hold, I don't know, 100,000 barrels. Wow, can you imagine? Someone's going to pay you $37 to take their oil for a month. And at the same time, this was the May expiry. So in the US, they trade monthly contracts. And the May contract expired last Tuesday, hence the reason in the markets. Hence the reason why the following day it immediately jumped up, as we were then trading the June contract. But ever since then, the June contract has fallen as well. As you can see, it was above sort of $21 at one stage. But it meant that if you had storage, and you owned that oil having been given it and $37 a barrel on top, you could then sell it in the June contract for $20. You've made $57 a barrel without doing anything, just storing.
Of course. That'll do.
Now, what's going to happen by mid
May,
with the June contract? Who knows? But there may be a similar situation that brews there. But I think by then we'll have a lot more clarity on the lockdown measures, how they've eased, etc., and the impact on consumption. And it may be that the price reacts positively, but everyone knows about what could happen, and the oil market is just not responding, as you've seen today. We're off quite a bit already, aren't we, on the Far East market setting the tone. I mean, that's off a good buck, isn't it? Maybe more.
Well, yeah. I mean,
$2, isn't it?
About $3, nearly $3. It's off from Friday's close. So, I mean, you would think that we're not going to suddenly solve the supply problems if they're still creating or pumping more oil than we're using, then really we should have even bigger problems in a few weeks' time when the next contract stops.
You'd think so.
Unless suddenly we can make a load of storage tankers, in which case maybe we should all be investing in storage tanker companies. Maybe that's the thing to buy right now.
Yeah, I mean every single oil tanker, floating oil tank, that the ships that deliver the crude from one end of the world to the other, they're all full. They're all sitting in outside ports. Singapore has got an armada of oil tankers full to the brim, moored up, waiting for the time when the price rallies. And to say that there's going to be an overhang, God, it's an understatement. It's going to take some time before this price really gets back to anywhere it was before this whole COVID-19 started.
Yeah, it's fascinating. The weird thing is, and I was sort of talking to my wife about this last week, and she sort of looked at me like, just stop being so boring. But it was such a one-off, such an amazing situation. And of course, when you're not in the office, it's sort of hard to talk to people about it because they look at you like, what are you talking about? I don't care.
But of course, no one can benefit from the obvious thing, which is cutting petrol and diesel prices, because none of us are going out.
Yeah. It's a curious irony, isn't it?
I had to fill up my car once I think it was last week, because I make a couple of trips to the office per week to get mail and just check it's still there. And I'm hardly using any diesel at all. But I think I filled up at 105. I wouldn't be surprised if it goes lower, to be honest.
Yeah. Well, I tell you one thing. I was speaking to a friend of mine who, one of his a friend of a friend is a security business, and he says they're doing ever so well because, of course, with a lot of companies empty, a lot of places empty, they're laying on security to look after it because of their insurance, and
Yeah.
so they're
Yeah.
having to recruit additional security staff to look over them. So there are these interesting sort of industries that are doing quite well at the moment, and of course plenty that aren't, sadly. But
Oh, yeah. And
anyway. So should we move on then, Jerry? Anything else to add before we look at the calendar?
no, that's we touched on most subjects, I think, there.
Okay. Well, look, let's bring the calendar up then. So last week we had a few things out which we talked about, things like the durable goods, things like the unemployment claims. Actually, a lot closer to expectations last week, the unemployment claims data, wasn't it, Jerry? And I guess are they getting a slightly better handle on things? Perhaps not. I mean, certainly
Well,
not
yeah,
really.
it's the initial sort of impetus, but it's still an horrendous number of jobs, Adrian. I mean, it's just shocking,
Oh God, yeah.
absolutely shocking.
Yeah.
I think in total, if you click on the right-hand side, that graph, you can see the scale of the unemployment claims so far since the effect of the COVID-19 epidemic has been felt. You can add up the 3 million, 15, 20, we're up to sort of 26 million jobs.
Yes, because this is new claims, isn't it? So
Yeah,
this is not this is not cumulative. This is new ones each month.
Correct. Each week.
Each week. Sorry, yeah, absolutely.
Yeah. I've never seen. I mean, I follow this stuff. You would 200,000, 300,000, not 6 million in a week. It's astonishing. Obviously, a lot of those will be temporary, short term, hopefully, but you just don't know with what's going to happen here. And there are lots of concerns still that I have about this pandemic never going away until we got a viable vaccine. And it's just.
Well, we can see some of the data from last Thursday in the Eurozone, like the flash services PMI data. And so we're expecting 28.3, which would be what a 50% contraction. I guess if 50 is the status quo, then that's not far off. But look at that. That means it's fallen by what, 70%? I guess, unless I'm sort of misunderstanding something.
No, you're not.
And in the Euro, I'm not sure which country that might be, but it's the whole of the Eurozone, perhaps. These are sobering figures, aren't they? Let's face it.
Yeah. They are just.
Should we have a quick look at the week ahead then? Let's get away from that. It's all a bit depressing, isn't it? So what do we need to have a look at for the week ahead, Jerry?
Okay, we've already we got a bunch of earnings. I've already mentioned that, and a few central banks having their monthly policy meetings. So we kick off Monday with one that's happened already. Bank of Japan had their monthly policy meeting. I think there's only so much that central banks can do, Adrian. I think the banks, we expect them to ease monetary policy, and a lot of them have done as much as they can do. And I think a lot of it now is up to governments to spend money where they can. Governments have got money to spend, that is. So the Bank of Japan have done pretty much what was expected. They boosted monetary stimulus in the form of more QE, more quantitative easing. They did have a cap on their amount of bond purchases. This is where they're buying sovereign bonds, which basically puts money into the financial system to lubricate and encourage businesses not to go to the wall, to have enough capital to survive the pandemic, which is the same argument for all the other central banks, by the way.
Yeah. Okay. And what else? So consumer lack of confidence. That's coming out on Tuesday as well.
Yeah, that's the conference board's reading, and it's these numbers are always very interesting because it tells us what future activity is likely to be. So what we refer to this as a leading indicator. So if the consumer is feeling happy, content, they'll tend to go out and buy goods. And if they buy goods, the companies that are selling them those goods are making more money. And so the circle goes on and on and on. But here, 90.1 is just horrendous. There's no historical chart we can look at, but believe you me, that's just shocking. So as you refer to it, it's a dire number, a lack of consumer confidence.
Yeah. Okay. GDP, advanced GDP coming in on Wednesday, 1:30 UK time. So minus 3.9 quarter on quarter.
Yeah, it's again shocking. And this is Q1. So this is the gross domestic product. That's the value of all goods and services produced in the United States in Jan, February, and March. It's the first of 3 releases. So after the end of the quarter, they rushed to try and get the data out. And you might say, well, hang on a second, it's already a month into it. But there's a lot of collating that has to happen. And this is the first reading. Curiously, the advanced reading is the one before the prelim number. You think prelim would come first, but anyway. So the advanced number, the very first reading, a 3.9% fall in Q1. Bearing in mind, we're really worried about what's happening in Q2. That's April, May, and June. So this
particularly with the US, because obviously they were a bit, later to the party with all the shutdown, weren't shutdown. So it's
right.
probably didn't even happen in March anyway. Really.
Well,
Maybe
I think
the
the markets have started to react quite badly. But I take your point.
No,
it's
but
Q2.
what I mean is things like lockdown measures is really what I'm referring to. That probably didn't really happen until as we moved into April, I would think, in the States.
Yeah, I'd say. Anyway, so GDP, and then on the same day, Wednesday, we've got the FOMC. So probably the most important central bank in the world. In fact, certainly at this stage, they have done as much as they can do to help the US economy. Jay Powell, who is the chairman of the Federal Reserve, chairman of the committee that sets rates, the FOMC, the Federal Open Market Committee, as it's called. We love acronyms. He said it was impossible to give forecasts because of the novel nature of this pandemic, and he's probably quite right. He's done as much as the central bank was expected to do, and I think it's eased most of the fear in the markets. What else could happen? They might announce more measures. It's probably going to be technical in nature, so I don't think there's going to be any great impact expected from the Federal Reserve this week. So that's Wednesday.
And then Thursday, similar sort of thing for the ECB, right?
Yeah, that's right. The European Central Bank meets, although it doesn't actually say European Central Bank on Forex factors. But anyway, they set the refinancing rate. They're not due to make any changes to the interest rate there. But it's the policy statement that will be interesting. I think more quantitative easing is pretty much guaranteed. They'll increase the scale of the quantitative easing, so buying more bonds and easing the restrictions on which bonds they can buy. There's not much more they can do, though, Adrian. Central banks have done it, and it's up to governments. I mean, in the good old days, governments used to control economies, not central banks. And it's up to governments to spend money in the right way to help their industries survive and be viable for when things do return to normal, whenever that might be. And some countries, certainly the southern European countries, are quite strapped for cash. So it's a dilemma that the EU is still wrestling with.
Yeah. Okay. And then finally, moving through to Friday.
May Day, normally a bank holiday. Well, in fact, it is a bank holiday in most European countries, but not the UK. We never have the 1st of May off unless it coincides on Bank Holiday Monday. But so very little out on Friday, but the UK markets are open, US markets are open, and we've got a reading on the manufacturing sector. Again, not the biggest sector in the US, but it's an important sector, obviously being the other one, the services sector, which is a lot bigger, like in most developed countries. But we've got a reading 36.7, for the expectation there, which is just not good.
And so, and the status quo is basically 50, isn't it? So that just gives you an idea in percentages. So
you just need to look at that chart again on the right hand side. If you click that chart emblem, you can see how shockingly bad it is. And I'm talking about, you can see going all the way back to 2012, 2010. It's never been this bad. It's just shocking.
Yeah, 2009, you sort of get down to those sort of numbers on the credit crunch, basically. But
yeah, that's right.
Yep, pretty grim. But then, of course, the other thing, just like we were talking about guidance from the FOMC and guidance from the Eurozone and the ECB, we'll be looking at guidance from stocks this week, won't we? So there's quite a lot of the big stocks that are reporting this week as well. Do you want to just give us one or two of the highlights, Jerry?
Yeah, just as we got the banks coming out in the UK, HSBC on Tuesday, Barclays and Standard Chartered on Wednesday, and Royal Bank of Scotland on Friday. Banks are pretty much unloved here in the UK now because the FCA prevented them from paying any dividends. And let's face it, there weren't many reasons to buy bank shares, and they've removed that last reason, so they're not loved by many. Big hitters in the US, we've got Alphabet, previously known as Google, comes out on Tuesday. We've also got in the US Facebook on Wednesday. Facebook and Google, or Alphabet, have been hit by a fall in advertising revenue, so it'll be interesting to see how well they've done and what guidance they're going to give. Apple, wow, out on Thursday. A fall in sales is a bit obvious, but by how much? We'll wait to see what they've got to say. On a completely different story for Amazon, they also released on Thursday. We all know how many Amazon packaging boxes we've got in our garages and barns, or barns in my case. It's just incredible. And I feel very guilty using Amazon because I wish I could use local suppliers, but they can't deliver or they're not open.
But I think it's a concerning story with Amazon. I think people are going to get even more used to buying stuff from Amazon than they were before. I hope people go back to looking after the local company if they aren't already.
You have to make a conscious effort to do that, Adrian. That's the only way to do it. But for now, if you want to get stuff done at home and you're waiting to get something delivered, it's the weapon of choice. But anyway, so Amazon on Thursday. Then we got the oil companies out there. Oil, wow, well, that's a big issue for a lot of companies. We got BP on Tuesday, big dividend payer. Are they going to cut their dividends? What's going to happen there? Royal Dutch Shell on Thursday in the Dutch/UK. Are they going to cut their dividends? There's that big debate happening. And then in the US on Friday, ExxonMobil and Chevron. So a lot of big hitters out this week. I think we'll have a better idea come Friday evening exactly what the prospects are for businesses, certainly the big business, as the pandemic progresses.
Yeah, I think you're absolutely right. So should provide us with lots of content for next Monday's podcast. So something for you all to look forward to. I can see the excitement.
Not that we're struggling to find something to talk about. It's fascinating times here, and quite distressing for a lot of people, a lot of businesses, a lot of individuals, and gosh, to say it needs reconciling sooner rather than later for a lot of people is an understatement, and I hope we can get it reconciled.
Yeah, absolutely. But of course, in the meantime, it is making for some very interesting moves on those financial markets, the FX markets, indices, commodities, and some great trading opportunities as well. And I know that, we've seen, speaking to a lot of people trying to trade the markets at the moment, but if they don't have the right strategies, it's becoming a very, very difficult time for them. So what we're doing this week is we're laying on three events this week to help teach home traders how to trade in the same way that we do. And we're teaching one of our trading strategies. It's called the sniper strategy. So 3 simple rules for helping to identify great trade turning points in the market. So if you'd like to come along and book in for one of our live trading events, please do so. You can go to our website, trend-signal.com, and you can book in from there, or visit the short link for our webinar registration page, which is bit.ly, so bit.ly bit.ly/learnts. So bit.ly/learnts. Book in for one of our upcoming events, and we'll teach you one of our favorite trading strategies here, how we identify great trades, some of the tools and technology that we use on a daily basis that help us to identify great trades as well. And the other thing with our podcast as well is that if you enjoy our podcast, please like it, share it, review it, whatever it is that you do with your chosen podcast provider. And also, if you want to have a look at a variety of different places to listen to us and watch us, you can listen to us on Apple iTunes. Just search for the Trend Signal podcast. You can listen to us on SoundCloud, Spotify, or even watch it as well on YouTube. Slightly different dimension watching it rather than just listening by going to YouTube, or even our little old website, which is trend-signal.com/trendsignal-blog. Okay, so trendsignal-blog, and you'll find where we upload our podcast on a weekly basis, and you can come through, listen to us, watch us, interact us. And of course, if you've got any questions, you want to interact with us, ask us the questions for next week's podcast, please do so. We love doing these sessions live. We love the participation of it, and answering any questions you might well have. So to do so, just send your questions through to info@trend-signal.com, and we'd love to go through any of your content and suggestions there. But otherwise, for myself, have a great week's trading. We'll be back next Monday for the podcast there. But for myself and Jerry, enjoy, stay safe, and we'll catch you next time. Bye-bye for now.
Yeah, bye now.